In a free market, high corporate profits act like a glowing beacon. That light irresistibly draws in outside capital from the edges of the economy, all of it looking for a way to capture a piece of that success. This competing capital enters the market to replicate the leader's products, expand the industry's capacity, and offer cheaper alternatives. This influx of competition eventually drives economic returns down toward the baseline cost of capital. The profit margin that once seemed secure is slowly ground away by the sheer volume of new participants. This is why basing a long-term strategy on temporary growth surges is a mistake. In a competitive system, exceptional success generates the very forces that eventually neutralize it. Public markets often ignore this long-term gravity. Instead, there is a near-term bias that fixates on quarterly earnings per share and immediate revenue growth, treating the current trajectory as if it will continue forever. This intense pressure forces managers to prioritize short-term targets. They are often incentivized to make choices that look good on a spreadsheet today, but weaken the company's future. A CEO might defer essential maintenance on a factory or underfund brand equity just to save enough cash to meet a quarterly projection. While these accounting adjustments create an illusion of profitability, they strip away the company's internal defenses. By the time a competitor arrives, the business has already been hollowed out from the inside. To find a business that can actually survive for decades, we have to look past reported accounting profits. We must focus instead on return on invested capital, or ROIC. Unlike simple earnings, ROIC measures how much cash a company generates relative to the total capital, the debt and equity, it has actually deployed. If a manager boosts short-term profits by neglecting their assets, ROIC will eventually reveal that the engine is becoming less efficient, making it much harder to hide the short-term trap. But even a high ROIC is vulnerable if it isn't protected by an economic moat, a structural, defensive barrier that keeps market gravity from pulling those returns back down to zero. Warren Buffett popularized this concept, comparing a high-performing business to an economic castle. He argued that the durability of the castle depends entirely on the depth of the water surrounding it. Assessing a company involves identifying these specific barriers. You have to determine if their structural integrity can withstand years of competitive entry and technological change. This chart compares two potential investments. Company A has a massive 40% return on invested capital, while Company B has a modest 12%. On the surface, Company A appears to be the superior choice. However, Company A's 40% return comes from a popular but transient product with no structural insulation. Because these returns are uninsulated, they will inevitably attract competitors who will undercut prices and expand supply until those 40% returns collapse. Company B's 12% return, while lower, comes from a highly insulated network, like a structural pipeline or a railway. This photo of pipeline construction shows why these networks are so difficult to disrupt. The sheer physical scale and capital requirements create a barrier to entry that is nearly impossible for a new competitor to replicate. This makes the 12% return predictable over decades. It is a more effective instrument for compounding wealth because the returns are protected by a structure that competitors cannot afford to attack. We can see this play out in real time by looking at how modern technological shocks, like large language models, expose different types of businesses. This diagram shows the business model for Gartner. They historically made money by packaging public data for corporate customers, but AI models can now bypass that process entirely, going straight to the source. Because Gartner's moat was built on simply organizing public information, it was a shallow barrier. Once a more efficient way to search that data emerged, the stock price dropped 31%. When a major technology shift occurs, any business that lacks a structural barrier faces immediate capital destruction. Now consider Moody's. Their business isn't just about data, it is protected by proprietary ratings and a strict regulatory mandate that requires their involvement in the bond market. AI cannot bypass a regulatory requirement. Instead, Moody's integrated AI to improve their internal analytics, which helped them maintain an incredible 51% operating margin. Calm, authoritative. Compounding wealth over the long term is not a matter of finding the fastest-growing industry or the most exciting new technology. In a market defined by competition, the only thing that dictates your long-term return is the durability of the walls you build around your capital.